For sure. Let's talk a little bit about changes that have happened recently. In 2020, there were changes to the stipulations or the general guidelines for, let's say, accredited investors and above. But also, there's been some changing, at least sound bites from guys like Gary Gensler and others who are on the public stage from a governmental or regulatory perspective. How have things changed in your view regarding, let's say, Reg D or private offerings on the back of this landscape of cryptocurrency and all these other things that are coming to market from a private placement perspective? Can you talk a little bit about some of that?
Yeah, sure. So, the crypto space is, kind of a different market right now. They're kind of in the midst of, looking at increased regulation there. We haven't recommended cryptocurrency to our clients from a fiduciary standpoint. Although we recommend, or we realize that, it might be appropriate to have some exposure there. However, we're not making a broad investment recommendation in that space. But as it relates to some of the changes, the Jobs Act really helped define exactly how accredited investor definitions, really changed. It allowed for, people that are licensed or registered as brokers to, become an accredited investor, and also outlined individuals that have, demonstrable education or job experience that will qualify them as having professional knowledge. So it broadened out the definition of what accredited investors are. And we see that as a positive. We think broader access to the alternative investment space is welcome. However, we want to make sure, as a fiduciary and allocator, we want to make sure that our clients are only investing where appropriate. Appropriateness is something that, as an RIA, we take very seriously. We want to make sure that, the types of strategies that we're recommending fit within, our clients' long-term goals and objectives. If you look at sort of trends in the space recently, like groups like Blackstone have really entered the space, the retail space, very hard, kind of raising, tens of billions of dollars in the B-REIT platform. They're launching out some of their private credit strategies in the space, and also, what they're doing in, the private equity space as well. Those types of investments, could be appropriate. However, when you're investing in illiquid asset classes and trying to put it into a liquid wrapper, there can be, issues of liquidity. So I know B-REIT was in the news a lot over the last few months, gating investors based on the fact that they had more redemptions that they were allowed to send out. It didn't necessarily mean there was anything wrong with the assets, but the fact of the matter is, when you invest in commercial real estate buildings, these are inherently illiquid investments. And so matching liquidity with structural frameworks around some of these strategies is important. And that's something we look at whenever we're evaluating, some of these more retail focused products that have lower accreditation requirements. And so, that's a risk, just like, equity risk or interest rate risk. That's a risk that we have to account for. And so, even though that the market has gotten, a lot more open and, broaden out the definition for the types of investors that can go in, as an advisor, we always have to make sure, okay, they might be accredited now, but is allocating to this strategy, is it appropriate?